Hey, how's it going? Paul Harris here, and today I'm going to talk about what auditors do day to day, okay? I'm going to go quite into detail about what they actually do on their day job. So if you're someone who's starting out becoming an auditor or thinking about doing it, I've made a video broadly speaking what auditors do, and now I'm going to go into a lot more detail to break down the day-to-day jobs and practically what you will be doing most of the time, particularly within the first 3 years as you qualify as an accountant at a professional firm. So you've started as an auditor, you're going to do 3 years at, say, PwC, KPMG. This should be a good breakdown of what you will be doing. So I didn't know this going in, so it's sort of, you just pick up as you go along what's going on. I mean, clearly there's training as you go along in these companies, but really it always feels like to me when I started that it was very specific jobs you were given, like do this, do that, and it's sometimes quite hard to get a broad picture of what's going on. So that's what I'm going to talk about in today's video. Hopefully it's helpful for some of you guys. So with that being said, let's get into it. I do want to make a point just to start before I get into it and start talking about what auditors do. The reason there's a sofa here pointing away from a TV is that basically me and my wife put a mirror on the other wall and then we watch everything back to front. No, that's stupid. Basically, I'm moving furniture around and there's a sofa here temporarily. Okay, fine, forget that, doesn't matter. So what do auditors do day to day? So in order to talk about this, I'm going to break it down and actually use a whiteboard to explain this, okay? So back to basics here. But you have to sort of understand the audit profession first to know why you're doing the things you're doing. So I'm going to talk it through and hopefully it'll all make sense and it'll be quite congruent. Okay, so here we go. So in my other video, which is worth watching, I talk about the audit in general. And basically what you're doing is auditing a set of accounts. So you have your P&L, your balance sheet, and you have your cash flow statement, and you have notes, okay? And then other things that aren't featured there is primarily, you have like the equity statement as well and some other documents, but that is primarily what makes up the financial statements. And financial statements, the notes section, are basically breaking down into more detail balances that occur within the P&L balance sheet and cash flow. So for instance, revenue, you might have several lines of revenue within your company. So the notes will actually lay out what the majority of that revenue is made up as. Because if you're a shareholder or someone who wants to buy shares in the company, you would look at a set of accounts and you want to know more detail than just what's on the surface of what's in the P&L and balance sheet. So as an auditor, you look at these accounts and you're basically auditing every single line within each of these statements and the notes and anything that's contained. So if you have a chairman's statement or a director's statement at the start of a financial set of accounts, which I haven't labeled here, then you have to audit whether they're true and fair in what they're trying to represent to people. So that's a kind of high-level version, which I've sort of talked about before. So now if we go into more detail, if you look at the profit or loss account, how are these broken down? Well, you have revenue at the top, you have cost of sale, then you have the gross margin or gross profit, which is the net of those positions. Then you will have your operating expenses. Then you'll have, it depends how you want to lay out your P&L, but basically you'll have interest costs, tax, lots more balances. It can be made, administrative costs. It depends how you want to show it, but fundamentally you'll have those sort of balances within your P&L account. When you're auditing your set of accounts, you have to go down these sections step by step and provide specific tests to each one of these to analyze whether it's fairly stated. Now, each test might be slightly different based on the risk criteria of what you're auditing. So if you think about what a company might want to do to show its statements unfairly, they may want to exaggerate how much revenue that the company has. And they might want to reduce the amount of costs that they're showing on their P&L statement. So when you're thinking about these tests, you have to understand how you can test the balances to capture what the main risk is. Okay, so with revenue overstatement, you will have to test it by checking that they're not putting revenue into the set of accounts this year that should have been in next year, or you might want to see if the invoices actually go through to cash, and that you can test the kind of customers that are included within your revenue statement, and you can see like through journals, you can see that something is being debited to your accounts receivable account and then credited to your revenue balance. And you can map out the flow in which the journals are posting to see if they're ordinary postings. Because if you see journals being posted from your fixed asset position to your revenue accounts, all of a sudden you might think that that's unusual, because that's not the general flow in which journals should work. So you have to go through them step by step and make tests, basically. And these tests cover off a certain number of risks. And you can split these into several categories. So you know that there are certain risks to all the balances. And these risks could be the cut-off risk. So that's the risk that certain balances show in the incorrect years. You can have accuracy. So that's that the balances are actually accurate. So when there's recording of an invoice, they've actually recorded the amount correctly. Okay, so it's not said 100 and they've written 1,000. There's valuation. And this is a situation where all the amounts that should be in the financial statements are there. So, for instance, if there's an impairment charge, you should be recording that amount within your financial statements, and that amount is recorded to the correct valuation. So there's a level of assumption there. And you have existence. And what that means is the invoices say that you're recording within your revenue actually exist, so they're actually there, they're not just fictitious. Then you have classification. This primarily say you have a cost of sales, and then you have operating expenses, and you want to make sure that these are correctly put into the right categories. Then you have rights and obligations. This basically means that everything that's recorded in your financial statements is correctly belonging to that entity, so that company. So say you had an asset on your balance sheet, that asset actually does belong to you, you've purchased it. And then you have occurrence, right? Hopefully I haven't missed any, but occurrence is basically that is almost the opposite of existence. So for instance, with existence is primarily related to revenue, where you're basically trying to see whether the invoices actually existed, whereas occurrence is that they might not have recorded the costs that are assigned to that company. So you have to check that they've actually counted all the costs and all the invoices that should have been assigned to the P&L for that year. So there you have a certain level of risks. So I'm going into quite a lot of detail here, but effectively, the reason why that's important is because to get your head around those, you have to assign those risks to specific parts of the profit and loss account and the balance sheet. And when you know exactly which risk assigns to what, you know why there's a risk there, and you know how you can test it. So, for instance, if I was to think about revenue, most of these effectively should be tested when you're testing revenue. You want to check, for instance, that the revenue is recorded in the right year, that they're recording their revenue accurately. There could be provisions that are made in the revenue, so income that doesn't have like accrued income. You could have existence, so that the revenue they recorded actually goes back to a specific customer, and that it goes back to an invoice or cash, and that it's all been recorded and it all exists. Classification, that revenue shouldn't be recorded as, say, an interest income has been recorded as revenue. Why is that important? Well, when you're a shareholder and you're reviewing the revenue position, it matters how they're growing their top line, and certain things like interest income, for instance, is not as important really unless it's a significant amount, because interest income could be relatively fixed, whereas revenue is scalable. Rights and obligations, that's more if you're sort of saying that the assets that are generating the revenue exist. And occurrence, that's probably less significant when it comes to revenue, because if you think, a company wants to record all of its revenue. The only time maybe occurrence would be in effect, say a company is kind of having a terrible year, they may want to not record their revenue and just then just push it into the following year, for instance. So occurrence kind of goes along with cutoff risk. So there are kind of risks that you need to assign to the testing you do on the P&L statement. This is a lot of detail, but it should hopefully be quite helpful if you just review this when you're about to start being an auditor. But hopefully, I know I've talked about a lot of theory, and I've said that I'm going to talk about practical stuff. But fortunately, I needed to talk about that. So now practically, you know the tests, you know the risks that you assign to each of the balances. So say you have a revenue position. Okay, so there's your revenue, is say, 100 million. So you know you need to test 100 million. So you can't effectively do this fully. You can't go to every single invoice that a company has delivered and, cash that's been received. You just can't do it. There's too much of this. So what you effectively need to do is sample test. So to sample test, you have to use a certain level of assumption. The first one is, what kind of company are you analyzing? Let's just say it's a regular kind of company where it's a profit-generating business and their aim is to grow their revenue. So there's certain metrics that you can use to come up with a level of materiality. So what does materiality mean? It means that you're satisfied that if there is an error under this level of materiality that you're finding in the results, you're happy to say that the testing was still successful. Because effectively a company is never going to get everything right. So say, for instance, that you have 100 million of revenue, you might assign a 1% materiality. What does that mean? Well, and you might assign it to the revenue, so 1% of revenue. What does that mean? Well, it means that if you, in combination of all the errors that you found in those financial statements, if they're less than that 1 million amount, then you're satisfied that their financial statements are materially correct. What this also does is give you an indication of the sort of level of testing that you need to perform in order to cover enough of the samples. So, for instance, if your materiality here was 1 million, because your revenue is 100 million, and then when you test your operating expenses, you still apply that 1 million, even if the operating expenses is 2 million, which is very low for a business of 100 million, but still. Now, what does that mean? Well, if you cover off testing of 1 million of this 2 million balance, you know the remaining amount that you haven't tested is 1 million. So you don't have to test any of that 1 million that's left, because you know no matter how much of an error that operating expenses is, it won't come to the 1 million that your materiality is. So let me explain that another way. If your operating expenses is made up of one invoice that's 1 million, 1.1 million, and 100 other invoices that is made up of 0.9 million, then you can just test one invoice and you can cover off the entire operating expenses balance. So that's the concept of materiality. It also produces a set of results of how many things you have to sample. So there isn't going to be a situation where you can just test one invoice within operating expenses. And you may find within revenue, for instance, if you have a materiality of 1 million, it might mean that you have to sample test 100 items. So almost like 100x of that amount. So you say you had 100 million and you had, say, 20,000 invoices. You don't have to test all 20,000 invoices. Because your materiality is 1 million, you might only have to test 100 of those invoices. So you sample test at random 100 of those invoices out of the 20,000 and say that all of them were correct. Well, then that out of the 100 invoices that you've tested, there was no material error. Say that of those 100 invoices that you tested, say there was an error of $1,000. Well, there's actually 20,000 invoices that could have been tested. You only tested 100. So what do you need to do? You have to go, well, 100 invoices were tested and I only had an error of 1,000. If I had tested 20,000, so you have to multiply the 1,000 by 200. If I had 20,000 invoices, so 1,000 times 200, you would have ended up with a 200,000 error. So you know, for instance, that 200,000 is lower than the 1 million. So you can go, okay, revenue has been tested. You've tested a certain amount of that. You've tested a certain number of the risk areas, and you know that materially the revenue balance is correct. And then you move on. And that's effectively how you sample test and the concept of materiality. I realize this video might be very long and that some of these principles might be a little bit confusing, but these are sort of the definite things that you need to know to test things practically. So there you have it. There's materiality, sample testing, and then also the risks. Now, okay, so that might still seem as theory. So let's really break down what you do. So your revenue in a company isn't just one number. You will have to ask for a listing of a general ledger. So that revenue might be split into, and it'll be random codes, let's say like 55001, and then you'll have a revenue A, and that might be, so you have 100 million overall, and revenue A might be like 50 million. Then you'll have 55002, and this is the general ledger codes. Now I'm really breaking down practically what happens here. And then you have revenue type, and you have amount. So then you'll have revenue B, and then it'll be like 20 million. And then 55003, C, 10 million, etc., etc., 55004, D, 20 million. So you have 4 different types of revenue there, okay? And then effectively what you do from that point on is you firstly compare that those total positions here, the total of all the general ledger amounts actually totals what they're saying on their financial statements. And this is how you slowly build up the testing, and it's very standardized in these large companies, and it feels very much like a tick box exercise, because so that's basically how the general ledger breaks it down, and that might be the first test. Literally is just to get the general ledger and confirm it to that. So we used to call them EGAs, I think, in PwC, but they're effectively, there's a testing template that you will get, and there'll be a revenue section. And there'll be test A, B, C, D, and I can't remember the exact names of them, but effectively test A will be to just get the general ledger, put it into a template that PwC has given, or any company, auditing company, and you're basically confirming that the general ledger amount agrees back to the 100 million. And these tests, and then you might have the substantive test, which is to test each of these general ledger amounts by getting a listing, because obviously this account here, 55001, if I just focus on this, will also break down into loads of lines of data. Now you hope that they're all invoices, but they may not be invoices, and these what you have to do is get this large listing and then compare that this total is equal to that total. And you have to filter this list, sort it, to get the highest value item. So say there's a £10 million item, you go, okay, great, I'm going to test that specifically. So you can split your sample into large items that you can test from that data listing and smaller items that you randomly test in the same way I described before, by taking a sample and whatever the error is, splitting it, extrapolating it up over the remaining items that you had to sample randomly. So you've selected higher value items like that 10 million. Now you might be able to find an invoice that goes directly to that 10 million, or you might find something annoying happens, like that line for 10 million splits down into another list of large items. So there's a lot of going through a lot of data, but effectively what you do once you've found some larger items and you've picked your sample of smaller items from that list, you then sample test them by saying, you go to the client and you say, I want you to provide me for revenue a certain set of documents. Now, those documents might change depending on what you're testing. So generally speaking, they're things like, for revenue, invoices and cash receipts. Effectively, if you know that they've billed this person, you can test that that amount matches back to one of these lines within the data that the customer provides you, the client provides you. Then you know that the invoice is correct, and then you check the cash statement, and you know that the cash has come in for the exact same amount as that invoice. And that'll be one kind of test to cover off the substantive element of revenue. So you've tested that, and you do that for each of the general ledger accounts. And you're always thinking about the materiality as a way of indicating how you can test this amount of balance. So that's basically it. That's pretty much your day job, is going through each of these different tests and testing the balances to a certain criteria, and making sure that the error rate within these balances is lower than your materiality. Now, obviously, with larger companies, some of these tests are just not feasible and wouldn't tick off enough of the risk. So if you're auditing a company like Apple, testing 1,000 of their invoices is not really a good enough scope to see that their revenue is not overstated. So within those companies, you rely on certain controls. Now, this is another area of audit that is, again, vast and has a certain level of risks attached to them, not the same as the substantive test risks that I explained earlier, but they're pretty similar. Now, a control is basically that, let's say, like a three-way match test, whereas if you're billing someone, they say that they've sent you a purchase order, and then you've invoiced them, and then there's a cash that's come in. Say a three-way match might be that you match those three documents, and that's a set control. Then there's physical controls, for instance, controlling the bank statement, so only a set number of people within the company has access to the bank. Or within payroll, for instance, that people who have left the company have been taken off the system and aren't being paid anymore, and that there's a physical check there. And these sort of checks build up a certain framework of the controls within a company. And because you have these controls, it will also allow you to lower the amount of substantive testing that is needed within the company. But these controls all need to be documented. So the revenue process, you have to document everything to do with what that company does to control that revenue is not overstated, that there's no fraud. And that is another huge part of the procedure, and that has certain tables that you need to complete and you need to tick off and ensure that they can evidence that the controls are in place. So that's another large part of auditing on your day-to-day job. And another large part is journals testing, which is sort of separate, but that's when you start getting into more like risk assurance, which is large data sets and ensuring that each journal is appropriately approved, and that the direction in which certain account balances have been posted is accurate. So what do I mean by that? Well, I described earlier testing revenue. So the main balances here would be accounts receivable, revenue, and cash. And why do I say this? Well, when you post a journal, the correct flow that you would expect to see when posting a journal is debit, accounts receivable, credit, revenue. And that means that there's a balance sitting within your accounts receivable account. Then the second balance would be to credit when the cash comes in, accounts receivable, and debit cash. So your accounts receivable balance has increased, your revenue balance has increased, then your accounts receivable balance has decreased, and that money is coming to your cash balance. Well, when you're doing journal testing, and say you have large data models, you can take every single transaction that company has done in a given year, and this might be with larger professional companies, but a big movement was to move into testing things through IT systems. Now, what you can take every single journal that's occurred, and if you're testing revenue, that pretty much everything should follow this process. And you can ask them if there's any exceptions, but you know that everything should follow this process. So assuming that, you say every journal needs to go between AR and revenue, and then you want to see that AR goes to cash for the same amounts. And then you test it, and then what you end up with is anomalies. So situations where, loads of different types of situations where something doesn't follow this process. And you can effectively map it out for everything within the accounts, because everything should follow a certain path. And then you can test the anomalies of when it doesn't follow this path. And then assuming that everything is correctly following the path, that's another way that you can lower the amount of substantive testing where you're testing to invoices. Because if you know everything's following that specific path, they have very good controls, it's very hard to have something that's incorrect flowing through a system. And a lot of large companies now rely on IT systems to check that things are, that are accurate. You don't have people typing in every single invoice anymore. A lot of systems do this for you, and there's certain self-evident checks. So there's a lot of IT work that goes on, and that's another specific way that you can rely on the controls, is checking that those IT systems are working correctly. The overview of this is that you do all these tests, and once you've done these tests, you tick off the main risks that you know and that the partner knows are the risks of that company. And then once you've done these tests throughout the entire balance sheet and P&L and cash flow, you very much have an understanding of whether the accounts are fairly stated, and as a result, the partner will have to sign it, or director will have to sign a document that is like the auditor's statement, which is one of the final processes that goes into the set of accounts to say that the audit has gone through and that everything is fairly and truly stated. And that's basically it. Another thing to note is I focus a lot on the P&L. Now, the reason why I focus on the P&L is that's the most important, in my mind, document in that given year. Because if you know that if the balance sheet, if the opening position of the balance sheet is correct, and you have tested everything within the P&L, well, the P&L is effectively the difference between the opening position of the balance sheet and the closing position of the balance sheet. So if you've tested the opening position and it agrees to last year's closing position, you've tested everything within the P&L statement, and you know through journals that everything has been allocated correctly between the P&L and balance sheet, then you know that the accounts receivable balance is effectively correct because all the revenue is correct, and that's assigned to the balance sheet. So often at times when you're testing the balance sheet, it's sometimes an easier set of testing procedures, and you can put a lot of reliance on the P&L statement. Another thing to realise is that some of the tests you do when you start seem very simple, but they're often very important. So what do I mean by that? Well, revenue isn't the first thing that you test when you go into a company, even though that's when you go into an audit, even though I've talked a lot about that because it's a very important balance. One of the things that you might test is cash. Now, how do you test cash? You get a document from the bank that gets sent directly to you so that you know that the company hasn't altered it. And you can basically say that the cash position at the end of the year it aligns to what the bank has told you their cash position is. And you need to get every single balance correct. You have to confirm, because they're not just going to have one cash account. They might have several bank accounts, and you need to see that. You need to check that they have included all the bank accounts that they should be including. And so you test that. Now there's been, in recent times, a company called Wirecard, which is a German listed company. It was worth something like 20 billion. And the reason why that company is now in administration is because the auditors didn't check the cash confirmations from the bank. They ended up getting a third-party confirmation, obviously, and they had been doing that for years. So, see, it's a very simple test, and it would have been done by the most junior member of the auditing team, yet that's the reason why a $20 billion company, it's actually a European company, so that's probably euros, That's the reason why that company is now in administration. Now, obviously, there was a lot of fraud going on in that company to prevent the auditors from seeing that. But that's a test that is done, which is very simple to do. I mean, you're just checking it to, there's no assumption there. You're just going to the bank and saying, can you confirm this balance is correct? Now, it gets overlooked because it's the simplest. Whereas what the most senior members of an auditing team might do is test an impairment balance or test some sort of provision. You know, things that are harder to test because there's no like exact number to put on that. And at that point in time when they made the provision, maybe they didn't have all the information in the company to make an accurate provision. So you start finding a lot more errors where there's a lot more assumptions in the numbers. So effectively, that's what the more senior people on the team might be doing, is testing things where there's more assumptions. But actually, often at times, the most junior members of the team are doing the most important work by testing accounts receivable, because that's another thing where people can often find fraudulent activity is within your accounts receivable balance and your revenue. But AR, generally speaking, is a relatively simple one to test because you pick all the large customers that have debts with you, and you go to them and say, could you confirm that this accounts receivable balance is correct within your own records? You know, that's a way of testing accounts receivable. So there we are. So that's another thing to be aware of, is that when you start, you actually do a lot of the testing on the most important, but sometimes what seems like the most simplest of balances to test. And that's basically it. That's a lot of information. Hopefully that's useful to some of you out there. I'd be amazed if some of you made it right to the end, but hopefully it's useful if you are starting as an auditor. I can't imagine it being interesting to most other people, but there we are. So there you go. Hope you enjoyed that. Thanks for watching, and I will see you next time.